Yeah, morning traders. We are seeing the markets coming alive with the sound of CPI-inspired volatility. It's a fairly dark picture for risk, but I think what we've been seeing from the numbers will give the Fed a few headaches, and obviously the market's had to digest that. Now, going through the week, we are going to be hearing from a number of Fed members, so it'll be interesting to see their take on this CPI number. We're going to be hearing from Charles Goolsbee, from Raphael Bostic, and from Mary Daly as well. And we do hear from Christopher Waller, who, of course, is one of the more influential Fed members, but he's going to be talking more about the role of the US dollar going forward. So I'm not sure what we're going to be learning from that speech. But the market's obviously had time to digest what we've been seeing. We've seen some fairly pronounced moves across asset class. But if we break the numbers down, we saw headline inflation coming out at 0.31 of 1% month on month, and we saw core at 0.39 of 1% month on month. We did see a decline in core goods, but it was the core services number that the markets obviously had to digest and run with here. And we saw core services up 0.66 of 1% month on month, which was a hotter run rate than what we saw in the prior month. If we have a look at it across the different subcomponents, it was broad-based. Medical services were up 70 basis points. Hotels were up 1.8%, airlines up 1.4%, and owners equivalent rents were up 0.56 of 1%. If we go into the supercore number, which the Fed obviously put on our radar quite sharply recently, we saw core goods, ex-rents, ex-OER up 85 basis points. So again, a fairly pronounced number there and a hotter run rate than what we saw last month. If we have a look at this on a 3-month annualized basis on core, that increased 70 basis points to 4%. So again, something that we have to sort of work with here. Now we're going to take some various components of that. We're going to get the PPI numbers that come out on Friday, and that will give us a really clear understanding about what's going to happen with the core PCE numbers that come out at the end of the month. But one would suspect that we're currently running on core PCE around 29 basis points month on month, which obviously is a hotter clip than what we saw last month. Now, if we have a look at the market reaction, it has been fairly pronounced. If we have a look in treasuries, we can see twos up 19 basis points on the change so far. So we're trading around 444. We smashed through 450 and we're currently trading around 465 as I speak. 10s are up about 13 basis points. Going to real rates, we can see 10-year real rates up 7 or 8 basis points, but trading above the 2 handle for the first time in a while. We can have a look in rates and swaps as well and have a look at see how this has sort of changed the market's perception of Fed policy action. Obviously, March is a no-go now. Shut the door on that one. We can see that May is priced about 40% probability of a 25 basis point cut. And we can see it's June now, which is the sort of default date. So the market's now come closer to where the analysts were and obviously where the Fed have been guiding to. We can see about 25, 26 basis points or a full rate cut coming out by the end of the year. We're now left with about 3.5 rate cuts, 25 basis point cuts by December. So again, that feels about fair in terms of what we've been seeing there. Have a look at what we've been seeing in the US dollar, because the dollar is stronger on the session. We've seen euro dollar breaking through those support levels around 107.23. We've seen big, quite fairly pronounced moves in the Swedish krona, the NOK, the Swiss franc, and also in the Antipodean currencies. We've seen good action in dollar yen, obviously a big proxy of what's happening in US rates. But we've seen that trade 149.30 up to 150.85. So a decent move there. And we're now looking up at those November highs of 150.120, and it feels like it probably gets there in the short term. Obviously, that move in real rates that we've been seeing, what we've been seeing in a stronger US dollar, has impacted the gold market pretty heavily. We were trading around 2030 prior to the CPI print. We've lost about $27 or about 1.4%. Conveniently, actually, if we look at elsewhere in the commodity complex, we are seeing a big move coming through in that gas, another 5% to the downside. Crude, on the other hand, is sort of bucking the trend of what we've been seeing. But some fairly pronounced move that's coming through in the FX space. Equities are certainly very heavy on the day here. We've seen a big pickup in people looking to hedge. You can see that in 1-month puts. S&P 1-month puts have added a couple of vols. You can see the VIX is now trading close towards 16%. And you can see some very big moves coming through in cash markets playing through. Certainly the Russell has been pretty badly beaten up today. We can see most short baskets are down nearly 6% on the session. We've seen the KRE down nearly 5%, and certainly small caps, after having a pretty good day of late, have seen a big reversal playing through. So a decent liquidation, a big pickup in hedging activity playing through there as well. Now, what does this mean for Asia? We are going to see a heavy picture, as one would imagine, We're calling down the ASX down about 1.3% for the cash open there. And we've got the Nikkei, which of course has been on a blistering run, is expected to open about 90 basis points lower. So a big day in the office here. Obviously, we've seen a big reaction in rates. Front end yields have moved sharply higher. The dollar's stronger on the day. We'll have to see how this continues and see how Asia trades it. But obviously, the market had a big rethink. It does seem that June now is the default situation for a rate cut.